Hey, what's up guys? In this video I'm going to show you how to add a vehicle, another asset into your QuickBooks. So I'm going to demonstrate in 2017. So this is the balance sheet. You'll see that it's empty right now. So this is a very simple setup. What you want to do is create a journal entry. And you will get all your information from the purchase agreement that you get from your vehicle or any kind of equipment that you're buying. So I'm going to say that I bought this in May of 2017, and we'll label this 2017 Volvo purchase. So I pre-made these accounts already. You can go into the chart of accounts and create these, but usually when I'm making new assets or liabilities, I'll just create it right in the journal entry. So I would just label this. I'll actually just make a new one, so I'll do a Volvo I'll just say 2017 Volvo. Alright, and then I'll add a new account here, and we'll go into fixed assets, and then the detail type we could just put vehicles. Okay, we'll leave this blank, and we'll save that, and we will say that we bought this for $41,000. So anytime you increase the asset, you want to debit that in the journal entry. So we bought it for $41,000. Now we took out a loan, so when you look at the purchase agreement, it should have all the information in there. So we're going to assume that the loan that we took out is $40,000. So you would create another account, and we'll say, we'll just label it Volvo loan. So we can even put the year in there. Maybe we have several of these vehicles that are different years. And even a good practice, if you have multiple vehicles, you can even put the last four of the VIN number. So we'll just tag that in there. And we'll do a long-term liability. And this will be a notes payable detail type. And we'll save that. And we know that the loan was $40,000. Okay, so we're not completely done yet because our debits have to equal our credits. So we're going to assume that we had to at least put down $1,000 as a deposit. So if it came from your bank account that's already in your QuickBooks, you would just put the bank in here, and then that would be credited because the asset is going down. A bank account is an asset, so you spent $1,000, we're going to credit that, and now our debits equals our credits. Okay, and maybe if you didn't use the bank account, maybe you just had to use your personal account. In that case, you would just do an equity. So you just do a owner contribution distribution equity. Okay, but we're going to use the bank account, and we'll save that. Now let's go into our balance sheet. Now we see the bank account went down $1,000. We we now have our fixed asset here, the 2017 Volvo for $41,000. That's what we bought it for. And then we have our loan sitting here for $40,000 as a long-term liability. All right. So let's create one more. Maybe we could do two more here. Maybe we bought that Volvo as a semi truck, and we also bought a trailer with it. So this is a 2014 Dragon trailer. Okay, and maybe we bought that on the 15th. So we'll do the same thing here. We'll create this asset. Okay, this is a fixed asset again. And we can put this as equipment. And we'll say we bought this for $15,000. And then let's say we used our personal bank to buy this. So we'll put it into a owner contribution distribution equity account. Okay, so there's our trailer. We bought that all in cash, so we spent $15,000. We didn't take out any loan, so that's just a very simple journal entry. Okay, so now we have both of our assets in here, and then we still just have our one loan for $40,000. And then you can see here the owner contribution distribution hits in the equity account for $15,000. So let's do one more. And let's say 6-1. We bought a 2014 Chevy Cruze. So we'll do the same thing. And I already have this in here. We'll say we bought it for $8,000. And it came straight from our bank. So we did a cash purchase on this one as well. Save this. Okay, so we have our fixed assets, and maybe you decided you want to split your trailer versus your vehicles. You can put these into sub accounts. But let's go ahead and go into our chart of accounts. And we have our Volvo here. Let's edit this. And we want to put this in the sub account for, whoops, we need the asset here. Okay, the fixed asset. We'll make it a sub account of our vehicles. Okay. Now we'll see it on the balance sheet. We'll see our bank account is has $9,000 spent. We have our trailer, and then we have our vehicles. We have our loan for $40,000, and then our owner contribution. So now that these are set up, we want to make a payment on our loan. Let's go into our bank first, just to show you also real quick how you do this from the bank feed. So we had the $1,000 that we spent to buy the Volvo. What we can do is match this to that journal entry. So you'll see here, Volvo purchase. We're gonna match that. And then you do the same thing for your cash purchases. So we have the Chevy Cruze purchase. We'll go ahead and match this in the journal entry. Alright, and one other thing that you can do, let's go back into our journal entry. It's good practice when you get these purchase agreements, they're gonna have the descriptions in there. So you can make this, you can add notes just so you know purchase price, purchase deposit, and what other details that you might have. You can put this in the description. And then you would add the attachment here, so you can always go back and take a look at it if you ever needed to. Alright, so let's do one more payment that's going to go towards our loan. So whenever you get your statement from, let's say, Volvo, they're going to give you the loan details, and it's going to be split into principal and interest. So you want to make sure that you split that up when you make these payments. So I just have an example here with a payment schedule. So $40,000 is our loan. So we'll say, so that doesn't really look right, but let's just do an example anyways. So we're gonna do a new expense. Normally this would just come right out of your bank feed, but for this example, so we're gonna say Clayton Volvo is the vendor. Alright, so 6-1, we want to put this towards the principal and the interest. So we have our Volvo liability account, right? So we want to put it towards this long-term liability, and well, the principal, we'll just say it was $100, and then we need to put the rest of it into the interest. Okay, and we'll just say it was 900 towards interest. Okay, so we spent 1,000. That's how you would split it. We'll save this, and we'll dive into our loan here. So let's go into our reports. We'll look in our balance sheet, and we'll go into our loan here. So So you'll see that our long-term liability loan has gone down $100 because that's how much was put towards the principal. And there you'll see it. So now our new loan is $39,900. So this should match what it has on the loan statement that you're sent from them. And you want to just double check that this number is right. And then if you go back into your profit and loss, you should see that interest payment. So there's the 900 that pops up. And that's how you would split it with the loan. So that's pretty much it. You just make a simple journal entry, make sure that you put it into the correct debit or credit. So whenever it's an asset, when you're adding that asset, make sure you put it on the debit side. And that's really all you need to remember, and then everything else will offset it. And then this is how it should look on your balance sheet. So if you guys have any questions, feel free to leave a comment. And if you want to see other videos like this, please let me know. Otherwise, I appreciate you guys watching this video. I hope that it was helpful, and I'll see you on the next video.